Picture turning 65, expecting to retire, and realizing you simply can't afford to stop working. For millions of Americans in 2025, this isn't just a worst-case scenario, it's the reality. According to the latest data, the average American believes they'll need $1.26 million to retire comfortably, but most are nowhere near reaching that number. Only about a third of young adults feel prepared for retirement, even as costs keep climbing. So, what's holding everyone back? It's not just one thing. Housing prices outpace incomes, inflation chips away at savings, and Social Security isn't keeping up. The assumptions about how to save for retirement no longer match the numbers. The retirement math that no longer adds up. For decades, financial planners promoted a simple formula. Save 10 to 15% of your income, invest steadily, and you'll be set for retirement. But in 2025, the numbers behind this advice no longer hold up. The economic landscape has shifted. People are living longer, costs are rising faster than wages, and the old benchmarks for security have become increasingly out of reach. Americans now expect to need $1.26 million to retire comfortably, according to recent surveys. Yet, most are falling far short of this target. The problem isn't just about personal discipline. The very structure of work and saving has changed. Life expectancy for a 65-year-old is now about 85, and half of retirees will live even longer. This means retirement savings must stretch for 20 years or more, a prospect the old formulas never fully accounted for. Wage stagnation compounds the problem. Since 2000, inflation-adjusted median wages have barely budged, hovering around $75,000 for households. Meanwhile, the cost of essentials, housing, healthcare, and education has far outpaced general inflation. The result is a steady erosion of purchasing power. Even diligent savers struggle to keep up, as the gap between what people earn and what they need grows wider each year. Systemic undersaving is now the norm. Fidelity reports that only 18% of workers max out their 401k contributions, despite widespread awareness of the need to save more. Most employees contribute far less than the recommended 15 to 20% of their income. Automatic enrollment programs have increased participation, but median contribution rates remain stuck around 6%. The shift away from traditional pensions has left individuals responsible for their own retirement security. But the tools and incentives haven't kept pace with the new reality. Investment returns, once the engine of retirement growth, now face headwinds. The S&P 500's forward P/E ratio hovered near 50 in 2024, the second highest since 2008, signaling that future returns may fall short of historic averages. Bond yields remain below 3%, and stock dividend yields are only about 1.4%. These conditions undermine the reliability of the 4% withdrawal rule, a long-standing guideline for drawing down savings. In today's environment, retirees are advised to limit withdrawals to 2.5 to 3% to avoid running out of money, which means needing 40% more in savings just to maintain the same standard of living as previous generations. Healthcare costs add yet another layer of uncertainty. A 65-year-old couple retiring in 2025 will likely spend $350,000 on medical expenses, not including long-term care. This projection assumes Medicare benefits remain unchanged, though the program faces ongoing financial challenges. For those who retire before qualifying for Medicare, premiums for private insurance can easily top $2,000 per month, straining even the most careful budgets. The traditional advice, maximize your 401k, avoid debt, buy a home, no longer guarantees a secure retirement. The underlying economic conditions that once made these strategies effective have shifted. Housing is less affordable, pensions have largely disappeared, and the costs that matter most continue to climb faster than anyone anticipated. As each of these factors converges, it's clear that retirement planning has become a far more complex equation. The next major obstacle stands out for its outsized impact on every generation. Housing, the retirement killer no one escapes. Housing stands out as the most persistent and universal threat to retirement security in the U.S. today. The ability to own a home, once considered a cornerstone of financial stability, has become increasingly elusive for most Americans. According to the National Association of Home Builders, 57% of U.S. households cannot afford even a $300,000 home. The median age of first-time homebuyers has climbed to 39, adding years of mortgage payments that now often stretch well into what should be retirement years. This delay in homeownership has major consequences for retirement planning. A buyer who takes out a 30-year mortgage at age 39 won't pay it off until age 69, leaving little time to enjoy mortgage-free living or redirect funds toward retirement savings. The traditional pathway, buying a home, in your early 30s, building equity and entering retirement debt-free, has broken down. For many, the years that should be devoted to saving and investing are instead spent covering high housing costs. Renters face even steeper barriers. The Joint Center for Housing Studies reports that 22.6 million renter households were cost-burdened in 2023, spending more than 30% of their income on rent. In high-cost regions, that figure can be much higher, leaving renters with little left over for retirement savings. The shortage of affordable rentals under $600 has grown worse, with 2.5 million fewer such units than a decade ago. This forces many to pay more than they can reasonably afford, delaying or derailing any hope of wealth accumulation. The reliance on family support is also rising. In high-priced markets, a growing share of young buyers rely on gifts or inheritances to make down payments. The proportion of young homeowners reporting down payment help from family has increased from 4% in 2019 to 6.2% in 2023, and nearly 18% say at least part of their down payment came from a gift or inheritance. This trend deepens the divide between those with generational wealth and those without, making socioeconomic mobility even harder to achieve. Wages have not kept up with housing costs. Since 2000, home prices have risen by 150%, while wages have grown by only 50%. As a result, buyers must take on larger mortgages relative to their incomes. At current interest rates, a typical $500,000 mortgage can cost nearly $3,000 a month before taxes and insurance, swallowing a disproportionate share of household budgets. In many cases, housing expenses now far exceed the traditional affordability guideline of 28% of gross income. Location further complicates the picture. The best job opportunities remain concentrated in high-cost metropolitan areas, where both rents and home prices are out of reach for most workers. Moving to a lower-cost region often means accepting lower wages, which can cancel out any savings on housing and leave little room for building retirement security. The challenges don't end once a home is purchased. Property taxes have risen 70% since 2000, and annual maintenance costs typically run 1 to 4% of a home's value. For a $650,000 home, that's $6,500 to $26,000 each year, money that could otherwise be directed toward retirement. Even after paying off a mortgage, these ongoing expenses can strain retirement budgets, especially for those on fixed incomes. Older homeowners benefit from having bought when prices and interest rates were lower, and some enjoy protections like capped property taxes. Younger buyers, on the other hand, face higher purchase prices, steeper financing costs, and rising taxes. The gap between generations continues to widen, making it harder for younger families to achieve the housing stability that underpinned their parents' retirement plans. For many, the absence of home equity means fewer options later in life. Without the ability to downsize or tap into a reverse mortgage, retirees face higher housing costs as a share of their income. Those still paying rent or carrying a mortgage into retirement are left with limited flexibility, often forced to keep working or make difficult spending cuts. While housing was once a reliable path to retirement security, it now stands as a primary obstacle. But even for those who manage to save diligently, other pillars of the retirement system are showing cracks that can't be ignored. The 401k mirage. For many workers, the 401k stands as the main pillar of retirement planning. On the surface, it looks promising. Participation rates are high, and the combined average savings rate, including both employee and employer contributions, reached a record 14.3% in early 2025. But a closer look at the numbers reveals a system that works well for a minority of high earners while leaving most savers far behind. Start with balances. The average 401k for people in their 50s is $558,740, but the median is just $247,338. For those in their 40s, the average is $344,182. while the median is $151,274. Among workers in their 30s, the median balance is $69,718, and for people in their 20s, it's only $29,753. These figures show how a handful of large accounts skew the averages upward. The typical worker, especially in their early and mid-career years, is not on track for financial security in retirement. Auto-enrollment and employer matches have helped boost participation, but they haven't solved the core problem. Most people still aren't saving enough. The record-high savings rate is driven in part by employer contributions, which rose to an average of 4.8%. Yet these contributions are not guaranteed and can be cut during economic downturns. Employees themselves deferred about 9.5% of their pay into 401k. Better than in past decades, but still below the level needed for true security, especially when factoring in market volatility and rising costs. Another weakness is the high rate of early withdrawals. Nearly 28% of workers cash out their 401k when changing jobs, paying taxes and penalties that permanently shrink their future nest egg. Even a single withdrawal can have a dramatic impact. If a worker in their 30s cashes out $50,000 after taxes and penalties, they lose not just the immediate value, but the decades of growth that money would have produced. Over a career of consistent saving, the difference between staying invested and cashing out can mean the difference between a comfortable retirement and one filled with financial stress. The system is especially tough on younger workers. Those in their 20s have the lowest balances and face the greatest pressure to contribute early. But stagnant wages and the rising cost of living make it difficult to save at the recommended rates. Even those who start saving at 25 must contribute a significant share of their income to have a realistic chance at reaching their retirement targets. For someone starting in their 40s, the required savings rate climbs to impractical levels. Fragmented accounts are another issue. Workers change jobs more frequently than ever, often leaving behind small 401k balances with former employers. These accounts are easy to forget or cash out, and those who roll them over may invest too conservatively, missing out on growth. As retirement nears, many shift their portfolios into lower-risk assets, but this can mean returns that fail to keep pace with inflation. Fees also erode returns over time. The average 401k charges about 1% in annual fees, which may seem small but can significantly reduce long-term growth. Target date funds, which are popular among savers, often carry higher fees without necessarily delivering better results. Many savers are unaware that these costs come directly out of their investment returns. The rise of gig work adds another layer of complexity. Roughly 43% of workers now earn income from gig platforms, but only 12% contribute to retirement accounts from these earnings. Without employer-sponsored plans or automatic payroll deductions, gig workers must navigate a patchwork of IRAs and self-employed retirement options, which few have the time or expertise to manage consistently. Market conditions further complicate the picture. While stock markets remain near record highs, the S&P 500's forward price-to-earnings ratio is elevated, suggesting that future returns may fall short of the historical average. This means savers will need to contribute even more just to meet the same retirement goals as previous generations. The fundamental problem is clear. The 401k system assumes steady employment, rising wages, and consistent contributions over decades. But most workers experience income volatility, job changes, and competing financial demands that disrupt this ideal. The result is a system that delivers secure retirements only for the highest earners and most disciplined savers. For everyone else, it's a supplement at best, and often not enough to cover the costs that matter most in retirement. Some of those costs are less visible, but no less significant. Healthcare's hidden retirement tax. Rising healthcare costs create a unique financial strain on retirees that most people underestimate until it's too late. For many Americans, the reality is that medical expenses in retirement act as a persistent drain on savings, often growing faster than any other household expense. According to recent studies, 78% of Americans worry about inflation's impact on healthcare, and 12% identify rising medical costs as their single biggest financial concern in retirement. This anxiety is well-founded. Healthcare costs are increasing at an annual rate of 6.2%, which is nearly double the rate of general inflation. The transition from employer-sponsored health insurance to Medicare often catches new retirees off guard. Many expect that Medicare will cover most of their medical needs, but the truth is more complicated. While Medicare does provide a baseline of coverage, it leaves significant gaps that retirees must fill themselves. Out-of-pocket spending on premiums, deductibles, and uncovered services quickly adds up. On average, retirees now spend about 14% of their monthly income on healthcare, a share that is only expected to rise as costs continue to climb. Prescription drugs are another area where costs can spiral. Even as some high-profile medications have seen price caps, many essential drugs remain expensive, and the average retiree takes multiple prescriptions each month. These expenses are compounded by the fact that Medicare's drug coverage often comes with its own limitations and out-of-pocket costs, leaving retirees to navigate a maze of copays, coverage gaps, and unpredictable price changes. Dental, vision, and hearing care are typically not covered by Medicare at all, forcing most retirees to pay out of pocket for these increasingly necessary services. The result is that many seniors delay or forego treatments, which can lead to more serious and expensive health problems down the line. Long-term care looms as one of the most significant risks to retirement security. Nearly 70% of Americans over age 65 will eventually need some form of long-term care, whether in the form of in-home assistance, assisted living, or nursing facilities. The costs for these services can be staggering, and most are not covered by Medicare. For many, the prospect of paying for long-term care means spending down assets or relying on family for support, which can undermine decades of careful financial planning. This burden is so significant that it causes many older Americans to delay retirement or continue working simply to maintain access to employer health benefits. Despite the availability of health savings accounts, HSAs, which offer tax advantages for medical spending, these remain underutilized. Only a small fraction of eligible workers contribute the maximum, and the average HSA balance for those nearing retirement is far below what's needed to offset even a few years of healthcare expenses. Contribution limits are also too low to make a meaningful dent in the total costs most retirees will face. Inflation compounds these challenges. Healthcare-specific inflation outpaces overall price increases, meaning that each year, retirees must stretch their savings further just to keep up. Over a decade, the value of a dollar set aside for healthcare shrinks significantly, eroding the purchasing power of even the most disciplined savers. This is especially problematic for those on fixed incomes, who find themselves allocating more of their limited resources to medical needs and less to other essentials or goals. The psychological impact of these mounting costs cannot be ignored. Many retirees express regret that they did not plan more aggressively for healthcare expenses before leaving the workforce. In surveys, nearly two-thirds of retirees wish they had taken healthcare spending into greater account during their working years. This regret is often amplified by the stress of navigating complex insurance options and dealing with unexpected bills, which can overshadow the enjoyment of retirement for many. While careful planning and delayed retirement can help mitigate some of these financial pressures, healthcare costs remain an unpredictable and often underestimated challenge. As retirees watch their savings erode faster than expected, it becomes clear that relying solely on traditional safety nets is increasingly risky. This growing sense of uncertainty sets the stage for another foundational concern facing future retirees: the Social Security illusion. Social Security, long viewed as a bedrock of retirement income, now faces challenges that are difficult to ignore. The 2025 Social Security Trustees report projects that, unless Congress acts, the program will only be able to pay about 75% of scheduled benefits by 2034. This depletion year was moved forward by 1 year in the most recent report, reflecting the growing strain of demographic shifts and slower-than-expected wage growth. Fewer workers are supporting a growing population of retirees, and the system's trust fund reserves are on track to run out sooner than anticipated. For millennials and younger generations, the outlook is especially stark. Even after accounting for later retirement ages, millennials are projected to receive about 25% less in lifetime Social Security benefits than baby boomers. The age for full retirement has already shifted to 67 for those born after 1960, requiring more years in the workforce just to access unreduced benefits. But the value of those benefits is eroding over time. At current inflation rates, a $2,000 monthly Social Security check in 2025 will only have the purchasing power of about $1,200 by 2045. This means that even if the nominal benefit stays the same, its ability to cover basic expenses will be cut nearly in half over the course of a typical retirement. The mechanics of the program amplify these challenges for younger workers. Every paycheck, 6.2%, is withheld for Social Security taxes, matched by another 6.2% from employers, up to a wage cap that rises each year but doesn't keep pace with the highest earners. Yet for many, the return on these contributions will be lower than for previous generations. As the system faces funding shortfalls, the likelihood of benefit cuts or higher taxes grows, putting added pressure on those with decades left before retirement. Early claiming is another factor that reduces income security. While the option to claim benefits at age 62 remains, doing so results in a permanent reduction, about 30% less than waiting until full retirement age. For workers in physically demanding or unstable jobs, delaying retirement may not be a realistic option, leaving them with smaller monthly checks and less financial flexibility in old age. Social Security's cost of living adjustments, COLAs, are meant to help benefits keep up with inflation, but the index used often underestimates the actual expenses retirees face. Healthcare and housing, which make up the majority of retiree budgets, tend to rise faster than the official inflation rate. As a result, even with annual COLAs, the real value of benefits continues to erode, leaving retirees with less purchasing power over time. The uniform national benefit structure also creates geographic disparities. A monthly check that covers basic needs in a low-cost state can fall far short in high-cost urban areas. For those who consider relocating to stretch their benefits, leaving behind established support networks and facing new tax rules can be a difficult trade-off. 13 states tax Social Security income, and in some cases, rates can reach as high as 8.5%, further reducing take-home income for retirees. The original intent behind Social Security was to replace about 40% of pre-retirement income for the average worker. With longer retirements, higher living costs, and the disappearance of traditional pensions, that target has become increasingly out of reach. Most retirees now rely on a mix of Social Security, personal savings, and whatever employer-sponsored plans they can access. Yet, 72% of Americans still expect to lean on Social Security, even as only 58% of millennials and 41% of Gen Z believe it will be there for them. The gap between expectations and reality is widening, and the need for alternative income sources is becoming more urgent. As Social Security's future grows more uncertain, retirees are forced to look elsewhere for stability. Many turn to the stock market to make up the difference, but this approach brings its own set of risks and limitations. The stock market trap. Stock market investing, once a reliable tool for building retirement security, now presents a series of obstacles that weren't as pronounced for earlier generations. In late 2024, the S&P 500's price-to-earnings ratio hovered near 50, the second highest level ever recorded, and more than triple the historical average of 15. This means that investors today must pay far more for each dollar of corporate earnings than their parents or grandparents did. In practical terms, workers now need to invest roughly 3 times as much capital to generate the same dividend income that funded retirements in the past. The impact of these high valuations is clear when looking at withdrawal strategies. In previous decades, retirees could withdraw about 4% per year from a balanced portfolio and expect their savings to last. With today's elevated market levels, the safe withdrawal rate drops closer to 2.5 to 3%. That small percentage difference translates into a need for 33 to 50% more savings just to produce the same annual income. For someone targeting $60,000 per year in retirement, the required nest egg jumps from $1.5 million at a 4% withdrawal rate to $2 million at 3%. Most workers simply can't bridge that gap within a typical career, especially as costs continue to rise. Dividend yields have also deteriorated. The S&P 500 now yields just 1.4%, less than half the 3% rate that historically provided a steady income stream for retirees. This forces current retirees to rely more on selling their principal investments rather than living off dividends. Each sale reduces the portfolio's future income potential, making it harder to maintain financial stability over the long term. Market cycles add another layer of uncertainty. Historically, high starting valuations have correlated with lower future returns. For example, when the Shiller-Cape ratio exceeds 30, subsequent 10-year returns average just 3.5% per year. Many retirement projections still assume 7 to 8% annual growth, but the reality is that savers are likely to see much lower returns, especially if they're investing during periods of overvaluation. This mismatch between expected and actual growth means that even disciplined savers can fall short of their retirement goals. The shift from defined benefit pensions to individual retirement accounts like 401(k) has amplified these risks. Pension funds could ride out market downturns thanks to large asset pools and professional management. In contrast, individual investors often react emotionally during market swings, selling at lows and buying at highs, which research shows can reduce long-term returns by 1 to 2% per year. This behavioral gap means that the average 401(k) investor often underperforms the broader market, further shrinking their retirement balances. Another issue is market concentration. Just a handful of technology companies now make up nearly 30% of the S&P 500's total value. This lack of diversification increases volatility, as large movements in a few stocks can sway the entire market. Many retirement funds, including popular target date options, are more exposed to these risks than savers realize. Fee structures, though often overlooked, quietly eat away at returns. The average 401(k) plan charges around 1% in annual fees, and managed accounts or advisory services can add another 1%. Over a 40-year career, these fees can reduce a portfolio's final value by nearly 30%. For most workers, these hidden costs represent years of lost savings. Inflation further complicates the picture. While most retirement projections account for inflation, they rarely adjust return assumptions downward to reflect periods of high market valuations. This creates a false sense of security, as real returns, the growth rate after accounting for inflation, can be significantly lower than anticipated. A portfolio earning 5% with 3% inflation only grows by 2% in real terms, barely enough to maintain purchasing power, let alone generate sufficient income. With bonds yielding less than inflation and alternative investments carrying their own risks, diversification no longer guarantees safety. Every major asset class faces headwinds, and the timing of market entry now plays a larger role in determining retirement outcomes than financial skill or discipline. Those who began investing in lower valuation eras have a significant advantage over today's younger savers. All of these factors combine to make the path to retirement far more precarious than it once was. Even those who save diligently and invest regularly face barriers that are largely out of their control. As traditional employment shifts and more people rely on non-traditional income sources, the challenge of building retirement security only grows more complex. The gig economy retirement black hole. The rise of gig work has quietly produced one of the most significant retirement gaps in the modern economy. Millions of Americans now earn income from platforms like Uber, DoorDash, and TaskRabbit, but only a small fraction manage to save for retirement from these jobs. According to recent data, 43% of workers participate in the gig economy, yet just 12% contribute any of their gig earnings to retirement accounts. This stark gap isn't just about individual choices. It reflects deep flaws in how gig work is structured. Unlike traditional employment, gig platforms offer no automatic payroll deductions, no employer retirement contributions, and no built-in savings mechanisms. The entire responsibility for retirement planning falls on workers themselves, many of whom see their gigs as temporary side hustles rather than long-term careers. Without the nudge of an HR department or the safety net of a 401(k) match, saving for the future is often neglected. Earnings instability is a constant reality. Platform pay compression is now widespread. For example, Uber drivers in 2025 earn less per mile than they did in 2019 after adjusting for inflation. This trend is not unique to rideshare. Delivery drivers and freelancers on other platforms face similar downward pressure on pay. As algorithms optimize for company profits, workers see their take-home pay shrink, leaving less disposable income to set aside for retirement. When every dollar counts, long-term savings are often the first thing to go. The unpredictable nature of gig work makes it nearly impossible to build steady savings habits. Monthly income can swing dramatically. One month's surge in demand can be followed by weeks of slow business. Unlike salaried workers, gig workers must first cover fluctuating expenses before even considering retirement contributions. This volatility leads to inconsistent saving, and research shows that irregular contributions result in much lower retirement balances over time, even if the total amount saved is similar. Classification as independent contractors adds more hurdles. Gig workers are excluded from employer-sponsored retirement plans and must rely on IRAs, which have lower contribution limits and more complex rules. The $7,000 annual IRA cap is a fraction of what can be contributed to a 401k. Navigating the paperwork, tax rules, and deadlines is daunting for workers juggling multiple gigs and unpredictable schedules, causing many to avoid retirement accounts altogether. Platform design choices further discourage saving. Features like instant pay encourage workers to cash out earnings daily, reinforcing a focus on immediate needs rather than future goals. Bonus structures and algorithmic incentives reward those who accept every job or work peak hours, pushing retirement planning further down the list of priorities. Even platforms that offer optional retirement savings features see very low uptake, as the onus is entirely on the worker to seek out and manage these tools. For many, gig work supplements declining wages from primary jobs. The typical gig worker spends about 12 hours a week across multiple platforms, often just to fill gaps in their main income. With little time or energy left for financial planning, retirement savings fall by the wayside. This is especially true for millennials and Gen Z, who make up the majority of gig workers but have the lowest retirement savings rates. Missing out on early career savings opportunities means losing decades of potential compound growth, creating permanent shortfalls in retirement security. Tax complexities only add to the burden. Gig workers must track every deductible expense and manage quarterly estimated tax payments, which eats into cash flow that could otherwise support retirement contributions. Many focus on minimizing current year tax bills at the expense of long-term wealth building. The result is a cycle where immediate survival takes precedence over future security. Older workers are not immune to these problems. Nearly 40% of gig workers are over 50, many having turned to gig work after losing traditional jobs. These workers face age-based challenges in securing higher-paying gigs and lack access to workplace retirement plans. Without the ability to build meaningful retirement savings, many remain in the workforce far longer than planned. The gig economy structure makes it difficult for workers to break out of this cycle. With pay rates set nationally but living costs varying widely, gig workers in expensive cities find it nearly impossible to save anything for retirement. The system, by design, encourages workers to focus on the next paycheck rather than long-term financial health. This growing retirement gap among gig workers is just one piece of a larger puzzle. For many, another major obstacle to financial security comes from the weight of student debt, a burden that now stretches well into what should be prime saving. Years. Student loans, the 30-year anchor. Student loans now function as a long-term financial anchor, weighing down the prospects of millions of Americans well into what should be their peak earning and saving years. The average graduate in 2025 leaves school with $42,000 in student debt, a figure that shapes every major financial decision for decades. Unlike prior generations who often paid off loans within a decade, today's borrowers routinely face repayment periods stretching into their 50s, fundamentally altering the timeline for building wealth and preparing for retirement. The mechanics of repayment make the situation worse. Income-driven repayment plans, intended to help those struggling with high monthly payments, often end up increasing the total amount owed. About 73% of borrowers on these plans see their balances grow over time because unpaid interest is added to the principal. For instance, a $50,000 loan at 6% interest, repaid over 25 years at $322 per month, results in $96,600 paid in total, almost double the original amount, with $46,600 going solely to interest. Each dollar diverted to loan payments is a dollar not invested for retirement, and the opportunity cost over decades is staggering. If that same $322 monthly payment were invested at a 7% annual return, it could grow to $300,000 over 25 years. This extended repayment timeline means that financial milestones are consistently delayed. Previous generations typically finished paying off student loans by their early 30s, freeing up cash for homeownership and retirement savings during their highest earning years. Today's borrowers often carry debt into their 50s, missing out on years of compounding investment growth. The result is a strong correlation between student debt and lower retirement account balances, as money that could be growing for the future is instead servicing old obligations. The structure of federal student loans compounds the issue. Federal loans make up the majority of student debt, offering flexible repayment, but often trapping borrowers in cycles of interest accrual and principal growth. Unlike other forms of debt, student loans cannot be discharged in bankruptcy and rarely have fixed repayment timelines, creating a persistent drag on household finances. Many borrowers in their 30s and 40s spend a significant portion of their after-tax income, sometimes over 15%, on student loan payments, often outpacing what they can afford to contribute to retirement savings. The psychological effects are just as real as the financial ones. Borrowers frequently postpone major life events, buying a home, getting married, or starting a family, because of the pressure to manage monthly loan payments. This sense of being perpetually behind makes long-term planning, including retirement, feel out of reach or even irrelevant. When financial security feels unattainable, saving for the distant future becomes a low priority. The impact extends beyond individual borrowers. Parent Plus loans, which average $37,000 per family, often saddle parents in their 40s and 50s with new debt at the very moment they should be catching up on retirement savings. These loans typically have higher interest rates and fewer protections, putting additional strain on family finances and further eroding the ability to prepare for retirement. Graduate and professional degrees add another layer of complexity. Law and medical school graduates frequently owe well over $100,000, with some debts exceeding $250,000. Even with higher expected incomes, the scale of these loans means that substantial portions of early and mid-career earnings go toward repayment rather than wealth accumulation. Attempts at relief, such as public service loan forgiveness and income-driven repayment forgiveness, have limited reach and often come with complex requirements or unexpected tax consequences. Many borrowers find that after years of payments, their principal hasn't budged, and any forgiven balance may result in a significant tax bill. Over time, these dynamics create a persistent gap in retirement readiness. Federal Reserve data shows that a typical borrower with $42,000 in student loans retires with $185,000 less in savings compared to peers without debt. This gap is driven by direct repayment costs, missed investment growth, and delayed financial milestones. The long shadow of student loans means that even diligent savers can face significant shortfalls when it's time to retire. As the financial pressures of student debt reshape the path to retirement, families face yet another challenge that quietly undermines their ability to save for the future: the childcare retirement trade-off. For many working parents, the cost of raising children has become one of the most significant obstacles to securing a comfortable retirement. The childcare retirement trade-off is a daily reality. Families must choose between covering immediate care expenses and investing in their own long-term financial well-being. With infant care now averaging $22,000 per year nationwide and reaching as high as $35,000 in some states, childcare expenses routinely consume nearly a third of the median household income for families with young children. This financial pressure forces parents to make difficult choices, often at the expense of their future security. The impact on retirement savings is immediate and lasting. Households with young children contribute about 37% less to retirement accounts compared to similar households without children. These reduced contributions during prime earning years create gaps that are difficult to close, even if families try to catch up later. The math is straightforward but unforgiving. If a parent in their early 30s reduces annual 401k contributions by $5,000 to pay for childcare, that decision can cost over $75,000 in lost retirement savings by age 65, assuming average investment returns. When this pattern repeats over several years, the cumulative effect is a significant shortfall that compounds over decades. The trade-off is further complicated by the push to save for children's education. Many parents feel pressure to contribute to 529 college savings plans, with the average family putting aside $3,200 annually. While the intention is to help children avoid the burden of student debt, every dollar directed toward a 529 plan is a dollar not invested for retirement. This diversion is most pronounced during the years when parents could be maximizing retirement contributions, leading to even larger gaps in long-term savings. Dual-income households are not immune to these pressures. In many cases, the second earner's income is almost entirely offset by the cost of childcare, taxes, and work-related expenses. For example, a parent earning $60,000 per year may find that after paying $22,000 for daycare, $15,000 in taxes, and $5,000 in commuting and other costs, only $18,000 remains. This leftover amount is rarely enough to replace the retirement contributions that are being sacrificed, and the family's overall financial position does not improve as much as expected. The financial burden of childcare extends well beyond the preschool years. After-school programs and summer camps add thousands in annual expenses, making it difficult for families to increase retirement savings even as children grow older. The average family spends close to $185,000 on childcare from birth through age 12. If these funds were invested instead, the potential for retirement growth would be substantial. But for most families, the immediate need for care takes priority. Many parents attempt to control costs by shifting to part-time or flexible work, but this often comes at the expense of retirement benefits. Lower-paying roles frequently lack employer-sponsored retirement plans or offer minimal matching contributions, reducing the long-term growth potential of retirement savings. Over a career, the difference in employer matches and missed contributions can add up to hundreds of thousands of dollars in lost retirement wealth. Geography amplifies these challenges. Urban families face some of the highest childcare costs in the country, while rural families may struggle with limited options and longer commutes. Both scenarios restrict the ability to save for retirement during critical years. Employer support is also limited. Only a small percentage of companies offer any form of childcare benefit or paid parental leave, leaving most families to shoulder the costs on their own. The psychological effects of these financial pressures are significant. Parents often feel caught between providing for their children's immediate needs and safeguarding their own future. This stress can lead to avoidance, with retirement planning postponed or neglected. Surveys indicate that parents are much more likely to delay creating a retirement plan compared to childless peers, even when workplace savings options are available. The long-term impact is visible in retirement account balances. Households that have raised children consistently report lower retirement savings than those without children, regardless of income or education level. The pattern persists across the country, suggesting that the childcare retirement trade-off is a systemic issue, not just a matter of individual choice. While tax credits and flexible spending accounts offer some relief, they cover only a fraction of actual childcare expenses. Policy solutions remain limited, and families are left to juggle competing priorities with little meaningful support. The result is a generation of parents entering retirement with less security than they expected, despite years of hard work and responsible financial behavior. These difficult trade-offs play out against a backdrop of rising costs that affect nearly every aspect of family finances. As parents struggle to balance today's needs with tomorrow's security, another challenge quietly erodes the value of their savings. Year after year, the inflation mirage. Inflation is often discussed in broad terms, but the way it actually impacts retirees is far more severe than the headline numbers suggest. The official inflation rate for the 12 months ending January 2025 was 3%, but this figure glosses over the reality that essential costs, housing, healthcare, and food, are rising much faster. For retirees, these categories make up the bulk of their spending. Housing costs have climbed by over 25% since early 2021, food prices are up nearly 25%, and healthcare continues to outpace both, with annual increases in the 6% to 8% range. The result is a higher effective inflation rate for seniors, one that steadily chips away at fixed incomes and makes it harder to preserve a decent standard of living. This discrepancy isn't just a statistical quirk. Retirees spend a greater share of their income on necessities that have been hit hardest by price increases. Healthcare alone now accounts for about 14% of the average retiree's monthly budget, and those costs are rising faster than any other major expense. A retiree who spends $1,000 a month on medical needs today may need nearly $1,800 a decade from now just to maintain the same level of care. Prescription medications, insurance premiums, and out-of-pocket expenses all contribute to this relentless upward pressure. For many, the gap between Social Security cost of living adjustments and actual expense growth means that each year, their benefits cover less and less. Housing is another major pressure point. Whether renting or owning, retirees are exposed to costs that have surged well beyond average wage gains. Mortgage interest rates have risen by more than 50% since 2021, and property taxes and insurance premiums are not far behind. Even those who own their homes outright find that the ongoing expenses, maintenance, taxes, and utilities, are taking a bigger bite out of their budgets. Renters face annual increases that often exceed general inflation, making it difficult to predict or control living expenses from year to year. Food costs have also become a persistent challenge. From 2021 to late 2024, grocery prices rose by almost a quarter, and retirees are particularly vulnerable to these increases. Many older adults have dietary restrictions that require specialty foods, which are often more expensive and less likely to be discounted. Unlike working households that can shift spending or substitute cheaper alternatives, retirees have less flexibility to adapt. This rigidity in spending habits means that inflation hits their wallets harder, and the impact compounds over time. Fixed income investments, once considered a safe haven, have not kept up. Traditional bonds and certificates of deposit now offer returns that barely match the official inflation rate, let alone the higher rates experienced by retirees. As prices for essentials climb, the real value of fixed payouts erodes. Retirees relying on these income streams are forced to either dip into their principal or reduce their spending, both of which can jeopardize long-term financial security. The mismatch between official inflation measures and retirees' actual experiences creates a hidden risk in retirement planning. Most financial projections assume a general inflation rate, but for someone whose expenses are concentrated in fast-rising categories, the reality is far more challenging. A retiree planning to live on $60,000 a year may find that, after a decade, they need closer to $80,000 just to maintain the same lifestyle. Yet, few adjust their savings targets accordingly, which leads to chronic undersaving and financial strain in later years. Social Security's cost of living adjustments, based on a wage earner index, consistently lag behind the real increases in retiree expenses. While COLAs provide some relief, they often fail to keep up with the true cost of living, especially when healthcare and housing are factored in. Over time, this gap only widens, leaving retirees with less purchasing power and fewer options. For many, the inflation mirage is not just a minor inconvenience, it's a fundamental threat to retirement security. Even the most diligent savers can find themselves caught off guard as their nest egg loses value faster than they anticipated. In this environment, many look for ways to supplement their income or close the gap, often turning to side gigs or small business ventures. The idea is appealing, but the reality is often less promising than it appears. The side hustle delusion. For many workers, the promise of a side hustle as a solution to retirement shortfalls is both tempting and persistent. The narrative is everywhere. Turn your hobbies or spare time into extra income, and you'll build a financial cushion for the future. But the numbers behind this trend tell a different story. While 69% of workers under 40 report earning supplemental income from side hustles, these efforts rarely translate into meaningful retirement. Savings. Most side gigs, from selling crafts on Etsy to driving for rideshare platforms, generate just enough to cover immediate expenses. For instance, the average Etsy seller brings in about $4,200 a year, but after accounting for costs and taxes, less than half remains, often just $1,500 to $2,000 annually. This sum might help with an unexpected bill, but it does little to address a retirement gap that can easily exceed $500,000. The reality is that platform algorithms and market saturation keep most side hustles small. Uber drivers in 2025, for example, earned 28% less per mile than they did in 2019, even before factoring in rising expenses. Similar downward trends are seen across other gig platforms, where competition and algorithmic pay cuts make it difficult to scale earnings. As a result, the dream of transforming a side hustle into a substantial income stream rarely materializes. What starts as a hopeful way to get ahead often becomes a cycle of long hours and diminishing returns. Spending habits further undermine the potential of side income. Research shows that 82% of side hustlers spend, rather than invest, their extra earnings. The money feels like a bonus, something to spend now rather than save for later. This mindset is understandable, especially when regular income barely covers essentials. However, the difference is significant. If a worker consistently invested a $200 weekly side hustle income at a 7% annual return, it could grow to $150,000 over 10 years. Instead, most of that money is consumed by higher living costs, lifestyle upgrades, or short-term needs. Tax complexities add another layer of difficulty. Unlike traditional employment, side hustlers don't benefit from automatic payroll deductions or employer-sponsored retirement plans. Instead, they must manage their own taxes and seek out retirement accounts like SEP-IRAs or solo 401(k)s. Many either aren't aware of these options or find the paperwork and fluctuating income too daunting to commit to regular contributions. The result is that only a small fraction of gig workers actually set aside money for retirement, and when they do, the amounts are often minimal. Time is another hidden cost. The average side hustler spends about 12 hours a week on these extra jobs, hours that could be used to develop new skills, pursue education, or advance in a primary career. Over time, this trade-off can limit opportunities for higher-paying roles or promotions, ultimately reducing total lifetime earnings. The focus on immediate cash flow often comes at the expense of long-term career development and financial growth. The structure of gig platforms also works against building lasting wealth. Features like instant payouts encourage immediate spending rather than saving. There are few, if any, automated systems to direct a portion of each payment into retirement accounts. This lack of automation means that saving for the future requires extra effort and discipline, something that's difficult to maintain amid income volatility and daily financial pressures. Demographics reveal that millennials, who make up more than half of all gig workers, are particularly vulnerable to this pattern. Early career years are critical for building retirement savings through compounding, but inconsistent side hustle income and low savings rates mean many will face permanent shortfalls. Even if a worker managed to save $5,000 annually from side gigs for 40 years at a 7% return, the resulting $1.2 million nest egg would only provide about $42,000 per year at a conservative withdrawal rate, barely enough to cover basic expenses, especially with rising healthcare and housing costs. Psychologically, side hustles can create a false sense of progress. The steady flow of small payouts feels productive and reassuring, but without a clear retirement plan, the underlying financial risks remain. Gig workers are significantly more likely to delay formal retirement planning compared to traditional employees, which can lead to missed opportunities and financial regret later in life. While some platforms have begun offering retirement savings products, participation remains low. Just 12% of eligible gig workers contribute. Irregular earnings, lack of awareness, and the demands of day-to-day expenses all play a role. Ultimately, the side hustle rarely lives up to its promise as a retirement solution. Instead, it often distracts from more effective strategies and leaves workers unprepared for the realities of aging. As more people look for alternative ways to secure their financial future, many turn their hopes to other sources of support. Yet, the next option on the list is just as misunderstood and, for most, just as disappointing: the inheritance mirage. Many workers quietly hope that an inheritance will fill the gaps left by insufficient savings or underperforming investments, but the reality is far less reassuring. The idea of a life-changing windfall is widespread, yet the typical inheritance in the United States is $46,000. This sum, while not insignificant, falls well short of transforming retirement prospects for most recipients. For a couple, it might cover a single year of basic expenses, hardly the financial rescue many imagine. In practice, this amount represents less than 10% of what the average worker needs to retire comfortably, making it a supplement at best rather than a solution. Timing further diminishes the impact. About 60% of inheritances arrive after age 55, which is often too late to change the trajectory of retirement planning. By the time these funds are received, the window for compounding investment gains has largely closed. A $46,000 inheritance invested at age 65 might grow to around $65,000 by age 80, assuming modest returns. For retirees facing decades of expenses, this boost is modest at best. More often, the money is used for immediate needs, medical bills, home repairs, or paying off lingering debts, rather than invested for long-term security. Inheritance patterns also reinforce, rather than reduce, existing wealth disparities. The top 10% of households receive about 80% of all inherited wealth, while the bottom half of Americans collectively receive just 8%. This means that those who are already financially secure benefit most, while those who could use a boost receive little. The cycle repeats across generations, making it harder for families without significant assets to break through to lasting financial stability. The expectation that inheritance will be a great equalizer simply does not match the reality. The process itself can further erode the value of an inheritance. Legal fees, probate costs, and administrative expenses typically claim 4 to 7% of an estate's value before any funds reach beneficiaries. For a median $46,000 inheritance, that's $2,000 to $3,000 lost to paperwork and legalities. Smaller estates are hit hardest, as they lack the sophisticated planning tools wealthier families use to minimize these losses. What's left is often split among multiple heirs, further diluting the impact for each individual. Expectations about inheritance are also shaped by cultural myths. Surveys show that nearly 3/4 of millennials expect to receive an inheritance, but less than half of their parents have formal wills in place. This gap between expectation and reality leads many to reduce their own savings, assuming that family money will arrive in time to cover shortfalls. When inheritances do materialize, they are often smaller and later than anticipated, providing less help than hoped during the critical years of retirement preparation. The assets passed down are frequently illiquid, adding more complexity. Real estate makes up a large share of inheritances, but selling a family home can trigger tax liabilities and emotional stress, while keeping it brings ongoing maintenance and property tax costs. These challenges force many beneficiaries into difficult decisions, often at times when they are least prepared to make them. Rising healthcare and long-term care costs also eat into potential inheritances. Many older Americans spend significant portions of their savings on medical and nursing home expenses in their final years. Medicaid rules prevent last-minute asset transfers, and the result is that a growing share of estates are depleted before anything can be passed on. Nearly a third of inheritances now total less than $10,000, barely enough to cover funeral or legal costs. Geography introduces another layer of disparity. Median inheritances in some regions are significantly lower than the national average, while high-cost coastal areas see larger sums passed down. Yet, retirement costs do not adjust downward in less affluent areas, leaving those with smaller inheritances at a disadvantage. Ultimately, the idea that inheritance will close the retirement gap is more myth than reality for most Americans. The sums involved are typically too small, arrive too late, and are distributed in ways that reinforce existing inequalities. Relying on a future windfall distracts from the need for proactive planning and leaves many unprepared for the realities of aging. As the gap between expectation and reality widens, the pressure to work longer and delay retirement only grows. The retirement age scam. What's often overlooked in conversations about retirement is how the very idea of a retirement age has shifted from a milestone to a moving target. The so-called retirement age keeps climbing, but the realities facing older workers are rarely acknowledged in policy or planning. Full Social Security benefits now start at 67, yet the average health span, meaning the years lived in good health, only reaches 69 for men and 71 for women. This leaves a narrow window between when most people can expect to claim full benefits and when their health is likely to decline, creating a disconnect between government policy and the actual experience of aging. For those in physically demanding jobs, this gap is especially stark. Construction workers, nurses, and others in labor-intensive fields often find their bodies wearing out years before they're eligible for full benefits. The system, however, is built on the assumption that everyone can keep working until at least 67. As a result, a majority of blue-collar workers end up claiming Social Security early, accepting permanent reductions in their monthly payments. These cuts can be as high as 25 to 30%, locking in lower income for the rest of their lives. This isn't just a personal setback. It's a systemic flaw that compounds the financial insecurity already facing millions of retirees. The problem isn't limited to manual labor. Even in white-collar professions, the pressure to work longer often collides with other realities. Age discrimination, shifting technology, and corporate restructuring mean that many professionals lose their jobs before they're ready to retire. The average white-collar worker faces involuntary job loss by age 59 or 60, and those who do find new work often accept lower pay and fewer benefits. This transition to so-called bridge jobs rarely allows for continued retirement saving and often just covers basic expenses. The notion that people can simply work longer to make up for gaps in savings doesn't match the realities of the job market. Healthcare coverage adds another complication. When employer-sponsored insurance ends before Medicare eligibility begins at 65, older workers face a coverage gap that can be financially devastating. COBRA or private insurance often costs hundreds of dollars per month, and many simply can't afford it without a steady paycheck. For some, the need for healthcare is the only reason they stay in the workforce, regardless of their physical or mental capacity to continue. Others risk going without coverage, which can wipe out whatever retirement savings they have managed to accumulate if a serious illness strikes. Economic trends further limit the ability to work longer. Wages tend to plateau in the 50s, while costs for housing, food, and healthcare continue to rise. Promotions and raises become less common, and older workers are often excluded from training or professional development that could help them keep up with workplace changes. The expectation that people can simply extend their careers by 5 or 10 years ignores the reality that opportunities dry up as workers age. There's also the matter of cognitive and physical demands. Many jobs now require constant adaptation to new technologies and workflows. For older workers, keeping pace can be challenging even in the best circumstances. The learning curve grows steeper with age, and workplace cultures often favor younger, faster employees. This isn't a matter of motivation or work ethic. It's a structural issue that leaves many older workers feeling left behind. Geography plays a role as well. In rural areas, job options for older adults are especially limited, and the types of work available often require physical stamina that declines with age. Urban workers may have more employment opportunities, but they also face higher living costs, making it difficult to scale back hours or consider lower-paying roles. The result is a landscape where delaying retirement is not just difficult, but sometimes impossible. Family responsibilities further complicate the picture. Many people in their 60s find themselves caring for aging parents or supporting adult children, adding another layer of financial and emotional strain. These obligations can force people out of the workforce earlier than planned, whether or not they are financially prepared. The financial industry and government policies have not kept pace with these changes. Most retirement planning models still assume a neat transition from work to retirement, with a steady income and predictable expenses. In reality, the transition is often abrupt and unplanned, triggered by job loss, health issues, or family needs. The expectation that individuals can simply work longer to compensate for inadequate savings is not only unrealistic, it can be harmful, increasing stress and accelerating health decline. The idea of a fixed retirement age has become more of an illusion than a reliable benchmark. The system's failure to adapt to longer lifespans, shorter health spans, and unpredictable employment means that many Americans arrive at retirement age with fewer resources and more uncertainty than ever before. This disconnect leaves people exposed to risks that can quickly overwhelm even the most careful plans. And for those who do make it to retirement, there's another challenge waiting, one that can threaten even the most robust financial strategies: the long-term care trap. Long-term care is one of the most overlooked threats to retirement security, yet it poses a risk that is both widespread and financially devastating. Nearly 70% of people aged 65 and older will need some form of long-term care during their lives. The costs are staggering. In 2025, the average annual price for assisted living is projected to reach $120,000, while specialized care such as memory care can run as high as $150,000 per year. These expenses can quickly exhaust even well-prepared retirement savings. Just 3 years in a memory care facility would cost nearly $500,000. an amount that would leave 92% of retirees without long-term care insurance completely depleted. Many retirees assume Medicare will help cover these costs, but that's a costly misconception. Medicare offers no coverage for custodial care, which includes help with daily activities like bathing, dressing, and eating. It only covers short-term skilled nursing after a hospital stay, and even then, coverage is limited to 100 days and comes with significant out-of-pocket costs. This gap between expectation and reality leaves families unprepared when the need for long-term care arises, often forcing difficult decisions at a time when options are already limited. For most, Medicaid becomes the fallback, but qualifying is far from straightforward. Medicaid's eligibility rules require individuals to spend down their assets to near poverty levels, typically just $2,000 in most states. Couples face their own set of restrictions, with the healthy spouse allowed to retain a modest sum, usually around $150,000, but this amount can vanish rapidly if care is needed for several years. The process often means selling a family home, draining retirement accounts, and sacrificing any hope of leaving an inheritance. The system effectively pushes middle-class retirees into poverty before any assistance becomes available. Timing makes the challenge even greater. Most people who need long-term care do so in their late 70s or 80s, long after they've stopped working, and when generating new income is no longer an option. At that stage, covering a $10,000 monthly bill for assisted living is simply unrealistic. Many retirees are forced to choose between rapidly depleting their savings or going without necessary care, with both options carrying significant consequences for quality of life and financial stability. Geography doesn't offer much relief either. While rural areas may offer care at a lower price, sometimes 20% less than in urban centers, the availability of quality facilities is often limited. Even in less expensive regions, annual costs can still exceed $90,000, a figure that remains out of reach for most. Moving to a lower-cost area may also mean leaving behind family and support networks, which are often essential for both emotional and practical support during periods of declining health. Insurance is rarely a complete solution. Traditional long-term care insurance has become prohibitively expensive, with premiums rising sharply in recent years. Policies can cost thousands per year and often require large upfront payments, making them inaccessible for many. Hybrid life insurance products offer another option, but the high entry costs put them out of reach for most households. As a result, only a small minority of Americans carry any form of long-term care coverage, leaving the majority exposed to potentially ruinous costs. The unpredictability of how long care will be needed adds yet another layer of risk. While the average stay in long-term care is around 2 to 3 years, about 1 in 5 people will require care for 5 years or more. Women, who tend to live longer and are more likely to be single in old age, face particularly acute risks, both financially and in terms of needing care without a spouse to assist. Family caregiving fills some of the gaps, but at a significant personal cost. Millions of Americans provide unpaid care to relatives, often sacrificing their own earnings and retirement savings in the process. The average family caregiver spends thousands out of pocket each year and frequently reduces work hours, leading to long-term consequences for their own financial security. Attempts to shield assets through trusts or early transfers are complicated by Medicaid's 5-year look-back period, which can penalize families for trying to protect their savings. Even legitimate planning strategies require foresight and careful legal guidance, which many people never pursue until it's too late. The emotional strain is just as real as the financial burden. Seniors often worry about the impact of their care needs on loved ones, while adult children face the difficult balance of providing adequate care and preserving family resources. This stress can lead to delays in seeking help, sometimes resulting in costlier emergency interventions that further drain savings. Long-term care is a challenge that cuts across income levels and regions, affecting nearly every family in some way. The need for thoughtful, early planning is clear, yet the available solutions remain limited and often unaffordable. For many, the search for a way to stretch resources leads to difficult choices about where and how to live in retirement, each with its own set of trade-offs. The geographic lottery. Retirement outcomes in the United States are shaped by what amounts to a geographic lottery. Where you choose to live, or where you're able to afford to live, can have as much impact on your long-term financial security as your savings rate or investment returns. The idea of simply moving to a low-cost state to stretch retirement dollars sounds appealing, but the reality is far more complicated. Take West Virginia as an example. It boasts the nation's lowest cost of living and the highest senior homeownership rate, with 85.6% of retirees owning their homes. Yet the median retirement income there is only $55,300, and just 13.7% of seniors are employed. While housing and daily expenses are more affordable, opportunities to supplement income through part-time work are scarce. Low costs alone do not guarantee comfort if there's little chance to earn extra money or access specialized medical care when it's needed most. On the other end of the spectrum are high-cost destinations like Hawaii, where the median retirement income reaches $96,500 and life expectancy is the nation's highest. But these benefits come at a steep price. The cost of living is so high that even retirees with above-average nest eggs struggle to maintain their standard of living. Home prices in popular retirement destinations such as Florida have also climbed sharply. In some Florida communities, the price of a typical home is now 8 times the local median income, putting ownership out of reach for most retirees unless they already possess significant wealth. Even renting is no longer a guaranteed alternative, as demand from wealthier transplants and part-time residents drives up prices beyond what most fixed-income households can afford. Healthcare access is another critical factor. Many low-cost rural areas attract retirees seeking affordable housing, but these places often have only one hospital serving several counties and lack specialists or advanced treatment centers. A retiree might save hundreds each month on housing, only to spend that savings traveling long distances for medical appointments or procedures. Medicare Advantage plans, chosen for their low premiums, frequently come with narrow provider networks, which can exclude major hospitals or specialists. These gaps are often discovered only after health problems arise, leaving retirees with limited options. The promise of remote work initially seemed to open new geographic possibilities, but for most, it introduced new risks. Companies often adjust salaries downward when employees relocate to less expensive areas, with pay cuts of 15 to 25% common. If a remote job ends, local employment rarely offers comparable pay, and the retiree can find themselves stuck in a market where their skills are undervalued and their housing costs are fixed. State tax policy adds further complexity. While some states advertise themselves as tax-friendly for retirees, the reality is more nuanced. States with no income tax often compensate with higher property or sales taxes, which can eat into retirement budgets. For example, Texas has no state income tax but property taxes that average 1.8% of a home's value per year. Tennessee exempts wage income but taxes investment earnings, which can penalize those living off retirement savings. These details can undermine the expected financial relief of moving. Climate and environmental risks are also changing the map. Florida's rising insurance premiums, driven by hurricanes and flooding, have doubled in just 5 years. Arizona's extreme heat now makes outdoor activity dangerous for much of the summer, pushing up utility bills for air conditioning. Coastal properties in the Carolinas are increasingly burdened by expensive flood insurance. What looks affordable on paper can carry hidden costs that only become clear over time. Social factors further complicate relocation decisions. Leaving behind a familiar community can mean the loss of informal support networks, neighbors, friends, and family who might provide help in emergencies or with daily tasks. Without these connections, retirees may need to purchase services they once received for free, adding to their expenses and increasing the risk of social isolation. Studies consistently show that seniors who lack strong social ties face higher rates of depression and cognitive decline, which can lead to increased healthcare needs and costs. The pandemic highlighted another challenge. As remote workers moved into smaller towns and cities, housing prices and the cost of services surged. Areas that once offered a low cost of living now see inflated prices, but without the employment opportunities or amenities found in larger cities. Early movers may have benefited, but recent transplants often find themselves paying more for less. Transportation is another overlooked expense. Affordable areas are often car-dependent, forcing retirees to maintain vehicles longer and pay higher annual transportation costs. Lack of public transit means even simple errands require a car, and those who give up city living for suburban or rural areas may not anticipate these ongoing costs. Ultimately, the Geographic lottery rewards those with substantial assets who can afford to prioritize quality of life over cost, or who do not need to rely on local employment or public services. For the average retiree, the trade-offs between affordability, healthcare, employment, and community often create new challenges as serious as those they hope to escape. The belief that a simple move can solve retirement's financial puzzle rarely matches reality. For many, the limits of geography only highlight the disappearance of another traditional source of retirement security: the pension fantasy. The idea of the pension as a pillar of retirement security lingers in the public imagination, but for most American workers, it's no longer part of the landscape. Today, only 13% of private sector employees are covered by defined benefit pensions, a steep drop from 38% in 1980. This shift has fundamentally changed the retirement equation, moving the burden of planning and investment risk from employers to individuals. Instead of guaranteed monthly checks, workers are left to navigate 401k plans, IRAs, and the ups and downs of financial markets on their own. The few pensions that remain are not immune to trouble. Multi-employer plans, which cover workers in industries like construction and trucking, are projected to be just 42% funded. Underfunding is a persistent threat, and even those who have earned a pension face the real risk of seeing promised benefits reduced. The Pension Benefit Guaranty Corporation, which is supposed to backstop failed plans, only covers a fraction of what many retirees were promised. When large plans like the Teamsters Central States Pension Fund faltered, thousands of retirees experienced benefit cuts that left them with far less than they had expected. Public sector pensions present their own set of challenges. In 28 states, liabilities exceed 20% of annual budgets, putting pressure on state finances and sometimes crowding out spending on education, infrastructure, or other public services. Some states, like New Jersey and Illinois, have funding ratios below 50%, forcing tough choices about whether to raise taxes, cut services, or reduce pension benefits for new hires. This has led to tiered systems where younger workers receive less generous benefits than their older colleagues, and the certainty that once defined retirement for public employees is no longer guaranteed. The loss of traditional pensions has left a significant gap in retirement security. Defined benefit plans once provided predictable income based on years of service and final salary, offering peace of mind to workers across a range of industries. Now, the median 401k balance for those nearing retirement is about $185,000, which translates to less than $1,000 per month in retirement income using conservative withdrawal rates. In comparison, many pension plans paid out more than $3,000 per month to long-serving employees, highlighting the magnitude of the shift. The erosion of pensions has also deepened inequality. Executive pensions and supplemental retirement plans are still common among top corporate leaders, even as rank-and-file workers are left to rely on market-based accounts. Nearly 90% of Fortune 500 CEOs continue to receive special pension arrangements that guarantee millions in retirement income, while the average worker faces rising uncertainty. This double standard has become more pronounced as traditional pensions have faded from the private sector. Attempts to reform or replace pensions have produced mixed results. Some states and companies have adopted hybrid or cash balance plans, which combine elements of pensions and defined contribution accounts. These often leave both older and younger workers dissatisfied. Older employees lose the security they expected, while younger workers find the new plans less generous and more reliant on individual savings. In the public sector, proposals to shore up pension funds often require politically unpopular tax increases or benefit cuts, neither of which offers a sustainable long-term solution. The psychological impact is hard to ignore. For decades, retirement was seen as a reward for years of service, a time when employers would provide for loyal workers. Now, individuals are expected to save, invest, and manage their own retirement funds, even as wages stagnate and costs rise. Many workers feel they've fallen short, but the reality is that the system itself has changed. The disappearance of pensions is a structural shift, not a matter of personal failure. As the landscape continues to change, workers are left to find new ways to fill the gap. Some look to part-time work as a bridge to cover income shortfalls in retirement, hoping it will be enough to make up for what pensions once provided. The part-time work myth. The belief that part-time work in retirement can reliably close income gaps is widespread, but the numbers tell a different story. Many older Americans expect to keep working in some capacity after leaving their primary careers, hoping that a few shifts a week or a flexible side gig will help them maintain their standard of living. But the so-called part-time work solution rarely lives up to expectations, especially when examined against the realities of today's labor market. For retirees looking to supplement Social Security or modest savings, the most accessible options are often traditional part-time jobs in retail, food service, or manual labor. In 2025, the median hourly wage for these roles is just $12. At 20 hours a week, that adds up to around $12,500 per year before taxes. Barely enough to cover even a single major expense like a property tax bill or a deductible for a health emergency. For someone facing a $2,000 monthly shortfall, bridging the gap would require working nearly full-time hours at these rates, which defeats the purpose of retiring in the first place. The gig economy, often marketed as a flexible alternative, presents its own set of challenges. Rideshare and delivery platforms promise independence, but older workers routinely earn less than their younger counterparts. Algorithmic biases favor drivers who can accept jobs quickly and work peak hours, putting retirees at a disadvantage. Recent data shows that workers over 65 earn about 22% less per ride than younger drivers, regardless of their ratings or reliability. Pay compression is also a factor. Uber drivers in 2025 make 28% less per mile than they did just a few years ago, after adjusting for inflation. Delivery app workers have seen similar declines, with average payments per job dropping steadily. These trends mean that what looks like an easy way to earn extra money often results in unpredictable, low pay, especially once expenses like gas, maintenance, and self-employment taxes are factored in. Physical limitations further restrict the kinds of jobs available to seniors. Many part-time roles require long hours on your feet, lifting heavy items, or moving quickly, tasks that become more difficult with age. Even less physically demanding jobs, like customer service, often require tech skills or fast typing, which can disadvantage older applicants. As a result, retirees are often left with the lowest paying, most physically demanding jobs, which can accelerate health decline and rarely provide consistent hours or income. Tax rules add another layer of complexity. For those who claim Social Security before reaching full retirement age, earning above a certain threshold results in benefit reductions, effectively a steep marginal tax rate on every extra dollar earned. Some pensions also reduce payouts if the retiree takes on additional work, further limiting the financial benefit of part-time employment. These penalties are rarely factored into retirement planning tools, so many discover them only after seeing their take-home pay shrink. Healthcare is another major concern. Most part-time jobs do not offer benefits, and private insurance for those not yet eligible for Medicare can easily consume the bulk of part-time earnings. COBRA or marketplace plans are expensive, and subsidies phase out quickly as income rises. For a retiree earning $30,000 from combined Social Security and work, monthly premiums can exceed $1,000, leaving little left over from already modest wages. The psychological impact of part-time work in retirement is often underestimated. Many retirees spent decades building careers, only to find themselves in low-status, repetitive roles that offer little fulfillment. The transition can be jarring, and turnover is high. Nearly 40% of seniors who take part-time jobs quit within 3 months. The combination of unpredictable hours, physical demands, and limited financial benefit leads many to cycle through jobs without ever achieving real stability. Competition for these roles is only increasing. With 10,000 Americans turning 65 each day, the pool of older workers looking for supplemental income grows steadily. This drives down wages and makes it even harder to find reliable, well-paying part-time work. Gig platforms and traditional employers alike are flooded with applicants, and older workers often find themselves pushed to the back of the line by younger, more flexible candidates. Ultimately, the idea that part-time work can reliably fill retirement income gaps is more myth than reality. For those with substantial savings or those who work for social interaction, these jobs may offer some value. But for retirees who genuinely need the income, the available options fall short, often by a wide margin. The numbers simply don't add up, and the risks to health, dignity, and long-term financial security are significant. This disconnect between expectations and outcomes is becoming increasingly difficult to ignore. As more Americans reach retirement age and find that traditional solutions no longer suffice, the broader reality of retirement in the U.S. comes into sharp focus. The harsh new reality. The reality facing today's workers is defined by numbers that are difficult to ignore. The benchmark for a comfortable retirement, $1.26 million by age 65, remains out of reach for most Americans. For someone starting to save at age 30, reaching that goal would require setting aside nearly $700 every month, assuming steady 7% returns. For those who delay until age 40, the required monthly savings jumps to more than $1,500. These figures represent a substantial share of median take-home pay, leaving little room for other necessities. For late starters, the math is even more unforgiving. Retirement becomes less a milestone and more a distant hope. Even as retirement savings rates have edged up, with combined employee and employer contributions reaching a record 14.3% in 2025, the gap between what's saved and what's needed continues to widen. Most workers now defer about 9.5% of their pay, bolstered by automatic enrollment and employer matches. Still, the typical balance for workers in their 40s remains far below what's required, and the median account size is a fraction of the seven-figure target. Incremental improvements in participation and contribution rates are not enough to offset decades of rising costs and stagnant wages. Previous generations benefited from a three-legged stool: pensions, Social Security, and personal savings. Today, only 13% of private sector workers have access to a pension, and Social Security's future is increasingly uncertain. The latest projections show benefits may cover just 75% of scheduled payments by 2034, further eroding a source of income that once formed the backbone of retirement security. The burden has shifted almost entirely to individuals, who are now expected to self-fund their retirements in an environment where wages have failed to keep pace with the demands of long-term saving. The housing market has only made things harder. With home prices at nearly 9 times the median income, younger generations face years of high payments that crowd out opportunities to save. The average first-time homebuyer is now nearly 40 years old, and the years that should be devoted to building retirement savings are instead spent servicing debt. Renters are no better off. Many spend close to half their take-home pay on housing, leaving little left for the future. Healthcare costs continue to climb, outpacing both inflation and wage growth. While some estimates put the needed savings for a 65-year-old couple at hundreds of thousands just for basic medical expenses, most workers are unprepared for these costs. Inflation in healthcare runs at more than double the official rate, steadily eroding the purchasing power of even the most disciplined savers. Long-term care adds another layer of risk, with costs that can quickly overwhelm retirement accounts. Stock market conditions have also shifted. High price-to-earnings ratios and low dividend yields mean that the old assumptions about market growth and safe withdrawal rates no longer hold. Savers today must accumulate larger balances just to generate the same income their parents did with less. For many, this means working longer or accepting a lower standard of living in retirement. The growth of gig work and the persistence of student debt add further barriers. Nearly half of workers now earn income outside traditional jobs, but only a small fraction save for retirement from these earnings. Meanwhile, student loan balances routinely delay homeownership and retirement contributions, locking younger workers out of the compounding growth that earlier generations relied on. Childcare costs and inflation compound these pressures, forcing families to make difficult choices between immediate needs and long-term security. The assumptions that underpinned retirement planning for decades, steady jobs, rising wages, affordable housing, and robust public benefits, no longer reflect the lived experience of most Americans. The result is a new normal where traditional retirement is increasingly reserved for the privileged few, and the majority face the prospect of working indefinitely or scaling back their expectations for later life. This is not a matter of personal failure, but a structural shift that demands new ways of thinking. As the foundation beneath the old retirement model erodes, the question is no longer whether the system is broken, but how individuals and society will respond to the new landscape. Looking at the full picture, it's clear that the retirement landscape has shifted in ways that most people never anticipated. The rules that once guided financial planning, steady jobs, affordable homes, and reliable public benefits, are no longer the norm. Rising costs for housing and healthcare, stagnant wages, and the decline of pensions have all contributed to a new set of challenges. Adapting to these changes requires more than individual effort. While personal responsibility plays a role, broader solutions are needed to address systemic issues. Recognizing the realities is the first step. Whether through policy changes or new savings strategies, the future of retirement depends on how we respond to these challenges as a society.